The classic 60-40 portfolio, which allocates 60% to stocks and 40% to bonds, has long been considered a safe bet for balanced investors. However, it is not a universal safety net. In 2022, the classic diversification strategy failed spectacularly. Traditionally, when stocks fell, bonds rose, cushioning the blow to a balanced portfolio. But that year, both asset classes declined simultaneously, leaving investors with nowhere to hide. Why did this happen? The answer lies in inflation. When inflation is high, it erodes the real value of bond payments, making bonds less attractive and causing their prices to drop. At the same time, high inflation squeezes corporate profits by increasing input costs, which hit stock prices. So both asset classes fall together. The 60-40 portfolio, which relies on the negative correlation between stocks and bonds, provided no protection whatsoever. It was a rude awakening for investors who believed in the balanced portfolio myth. The loss of diversification meant that the portfolio's risk was much higher than expected, and the drawdown was severe. This event highlighted the need to question long-held assumptions about asset allocation. The key insight is that the correlation between stocks and bonds is not constant, it depends on the inflation regime. In a low inflation environment, bonds act as a safe haven, rising when stocks fall, providing a buffer to the portfolio. But in a high inflation environment, bonds lose their safe haven status. They fall alongside stocks because inflation erodes their real returns and prompts central banks to raise interest rates, which directly reduces bond prices. This regime dependence is the core of the problem. A static 60-40 allocation ignores this dynamic. It assumes that the negative correlation is permanent, but history shows it is not. When the regime flips from low to high inflation, the portfolio's risk profile changes dramatically. The correlation can even turn positive, meaning that both asset classes move in the same direction, amplifying losses. Understanding this regime dependence is essential for building a resilient portfolio. To make the 60-40 work, you need to know when the regime flips. A simple rule is to compare the actual inflation rate to the central bank's target, which is typically around 2%. If inflation is above the target, the negative correlation weakens. The formula for the regime indicator is straightforward. It is the actual inflation rate minus the target rate. If this difference is positive, you are in a high inflation regime. If negative, you are in a low inflation regime. This simple calculation can guide your allocation decisions. For example, if the inflation rate is 4% and the target is 2%, the indicator is plus 2%, signaling a high inflation regime. In such a regime, you might reduce bond exposure and increase allocations to assets that perform well in inflationary times. This rule provides a practical way to adapt the 60-40 portfolio to changing economic conditions. In high inflation, bonds fail as a diversifier for two primary reasons. First, inflation erodes the real value of fixed coupon payments. Since bond coupons are fixed in nominal terms, their purchasing power declines as inflation rises. To compensate for this loss, investors demand higher yields, which pushes bond prices down. Second, central banks often raise interest rates to fight inflation. When interest rates rise, existing bonds with lower coupon rates become less attractive, so their prices fall. Thus, bonds do not just underperform, they actually decline in price. This is exactly what happened in 2022, when the Federal Reserve aggressively hiked rates. The traditional, safe asset became a source of losses, undermining the entire logic of the 60-40 portfolio. Investors who relied on bonds for stability were shocked to see them fall in tandem with stocks, eroding the diversification benefit. The real return on a bond is the nominal return minus inflation, as described by the Fisher equation. This is a fundamental concept in finance. For example, if inflation is 8% and a bond yields 3%, the real return is negative 5%. This simple formula explains why bonds fail in high inflation. Investors are not getting richer, they are getting poorer in real terms. The nominal return is an illusion because it does not account for the loss of purchasing power. When inflation is high, the real return on bonds becomes negative, meaning that bondholders lose money in real terms. This is why the 60-40 portfolio cannot protect you when inflation is high. Even if bonds provide a positive nominal return, the real return may be negative, and the portfolio's overall real value declines. Understanding this relationship is crucial for assessing the true risk of a bond-heavy allocation. Let's compare the two regimes. In a low-inflation regime, stocks and bonds are negatively correlated. When stocks fall, bonds rise, providing a buffer to the portfolio. This negative correlation is the foundation of the 60-40 strategy. In a high-inflation regime, however, the correlation becomes positive. Both stocks and bonds fall together, as seen in 2022. This is the crux of the issue. The 60-40 portfolio works well in the first regime but fails in the second. The problem is that you do not know which regime you are in until it is too late. By the time you realize that inflation is persistently high, the damage to the portfolio may already be done. This uncertainty makes a static allocation risky. Investors need to monitor inflation indicators and be prepared to adjust their asset mix to avoid the pitfalls of a regime shift. The static 60-40 allocation is a one-size-fits-all approach that does not adapt to changing economic conditions. It assumes that the historical negative correlation between stocks and bonds will persist indefinitely. But as we have seen, it does not. In high inflation, the portfolio becomes much riskier than intended. The risk is not just lower returns, it is higher volatility and deeper drawdowns. Investors who thought they were conservative were actually taking on significant risk. For example, in 2022, a 60-40 portfolio lost about 17%, which is a substantial loss for a supposedly balanced portfolio. This hidden danger arises because the static allocation ignores the regime dependence of asset correlations. By failing to adjust to the inflation environment, investors expose themselves to losses that could have been mitigated with a dynamic approach. The static 60-40 is a relic of a bygone era and needs to be rethought. So what's the solution? A dynamic allocation that adjusts the stock-bond mix based on the inflation regime. One simple rule is to reduce bond exposure when the inflation indicator is positive and increase alternative assets like commodities or inflation-linked bonds. The formula for the bond weight could be something like this: base 40% minus a penalty for high inflation. For example, if the inflation indicator is plus 2%, you might reduce the bond weight by 10 percentage points, bringing it down to 30%. This is a heuristic, not a precise model, but it illustrates the idea. The key is to be flexible and responsive to economic data. By adjusting the allocation based on the inflation regime, you can reduce the risk of simultaneous losses in stocks and bonds. This approach acknowledges that the 60-40 is not a set-and-forget strategy but requires active management. In a high-inflation regime, you need assets that actually perform well. Commodities, especially energy and food, tend to rise with inflation because their prices are directly affected by supply and demand dynamics. Inflation-linked bonds, like TIPS, adjust their principal with inflation, providing a real return that protects purchasing power. Real estate can also be a hedge, though it is less liquid and may have higher transaction costs. These alternatives can replace some of the bond allocation in a high-inflation environment. However, they come with their own risks. Commodities are volatile and can be affected by geopolitical events. TIPS have lower yields than nominal bonds, and their inflation adjustment may be taxed. Real estate requires significant capital and management. So the trade-off is real. Investors must weigh the benefits of inflation protection against the additional risks and costs of these alternative assets. Let's put some numbers on this. In 2022, inflation peaked at around 9% in the US, the highest in decades. The S&P 500 fell about 19%, reflecting the impact of high inflation on corporate profits and investor sentiment. Bonds, as measured by the Bloomberg aggregate, fell about 13%, due to rising interest rates and inflation eroding real returns. So both asset classes fell significantly. A 60-40 portfolio would have lost about 17%, calculated as 0.6 times minus 19% plus 0.4 times minus 13%, which equals minus 11.4% plus minus 5.2% equals minus 16.6%, roughly 17%. That is a significant loss for a balanced portfolio. These numbers illustrate the failure of diversification in a high-inflation regime. The simultaneous decline in stocks and bonds meant that the portfolio provided no cushion, and investors experienced losses that were comparable to a pure stock portfolio. This highlights the need for a more adaptive approach. The 60/40 portfolio is not a universal safe bet. It works in low inflation, but fails in high inflation. The key is to understand the inflation regime and adjust your allocation accordingly. This means being flexible, not dogmatic. It means monitoring inflation data and being willing to shift into alternatives. It means accepting that no static allocation is perfect. The 60/40 is a starting point, not a destination. By understanding the mechanism, you can make better decisions. For example, if inflation is rising above the target, you might reduce bond exposure and increase allocations to commodities or tips. This dynamic approach can help mitigate the risk of simultaneous losses. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.